Yeah, it's really, I mean, this is novel. It's the first time ever that investors have been able to participate in investment into owner-occupied homes, right? Like
Yeah.
the only way they've been able to do it before is they buy the home themselves. So that's a big cash outlay and debt, right? As
Right.
an active investor. Here, you're a passive investor. You're sitting back, to your point, saying, "Let my money work for me. Let me pick which city, or pick all of them by going in the select fund and see how this capital works." And again, owner occupied versus, it really puts the investor and the homeowner on the same side. The homeowner, right,
Yeah.
wants to see their home appreciate. They would like to have a nice gain on their home over a period of time. And so here we're well aligned with the interests of the homeowner and the investor at the same time. It's not a,
Yeah.
it's not like
Yeah.
a bank versus the homeowner.
Hello and welcome to Fireside with VC. My name is Andrew Romans, and today we are with Tore Steen, who is the CEO of Nada, one of our portfolio companies. Very interestingly, previously, Tore co-founded CrowdStreet, which is the largest online real estate investing platform in the United States. So you can see why, of every human in the world, he is uniquely interesting for us to recruit to be the new CEO of Nada. Not that new. Tore's been with us for over a year. It was about 2.5 years ago we invested first, introduced these guys to Live Oak, and we've co-invested at 7BC again with Live Oak into Nada. So Tore, thank you so much for joining us today.
Andrew, thanks for having me. Really looking forward to spending the time together.
Awesome. So the last time I had looked on, I don't know how much funding CrowdStreet had invested into real estate projects, it said something like $2.5 billion. What's the latest total of invested capital through your previous company?
Certainly, yeah. CrowdStreet's now crushed over 4.4 billion of equity. And just to put that in context, because people hear that number and they say, how many institutional investors? And these are all individual accredited investors. Average check size is between 25,000 and 50,000 per investment. So that just puts it at a size and scale that people can understand.
I mean, good God, brother, we've got to get you to raise money for my VC fund. That's crazy. That's crazy. Normally, you've just got to penetrate these sovereign wealth funds and endless endowments and stuff like that. It's also pretty fascinating to see, the democratization or retail investors being able to participate in that sort of thing. And can I just ask, I want to focus on Nada today, but maybe what's the range of types of projects that are even on CrowdStreet over the years? I mean, you were there for 11 years, I think.
Yeah, so we started the company in 2013. We launched the very first project in April of 2014. And over a 10-year span, we did over 770 projects. And they fall all within that commercial real estate umbrella. So about 50% are kind of large multifamily projects, kind of 250 units and above. Then the other 50% is made up of industrial projects, retail, mixed use. I don't want to say it, but office.
Right. Well, in some parts of the country, office is there. I remember I had a pretty cool home office on the day my twin boys were born. I was back into the office for sure.
Yeah, so that's so it falls under all food groups of kind of commercial, non-residential. So we'll talk about Nada because I'm excited to be on the residential, and I can compare and contrast a little bit to the CrowdStreet platform. But CrowdStreet was one of the very first platforms out there post the Jobs Act to take advantage of the changing regulations.
Amazing. And on the VC experience, all of this totally relevant to what you're doing today at Nada. Roughly how much venture, and I think some venture debt funding as well, that you guys raised?
Yeah, we raised over 50 million of equity from VCs as well as investors on our platform. So we ate our own dog food, as they like to say. So it was really, we can talk about that at a later date, but it's kind of a new way to be able to raise some capital. I wouldn't say it's all the capital, right? It's kind of supplemental capital. And then we raised about 15 million of venture debt on top of that. So a little, close to $67 million.
Okay, fantastic. And so all relevant to what you do today. So Tore, maybe explain to me what is Nada and how does Nada work?
Yeah, the best way to kind of sum it up is it's a two-sided platform. On one side, you have homeowners, and on the other side of the platform, you have individual investors. And the product that we're talking about, or the asset type, is what's called as a home equity agreement, or HEA for short. And it's a new investment asset type that really has only been around a few years. But from a homeowner perspective, it allows a homeowner to tap into the equity of their home. And instead of like using a HELOC where they have monthly interest payments and mortgage and debt payments, they're actually giving up equity in their home in exchange for cash. On the investor side, which is if you go to cityfunds.com, that's our more investor-facing asset types. And those are funds that allow investors now to participate in this HEA asset type. So as you can tell from my CrowdStreet days, I love two-sided marketplaces, two-sided platforms. They're really challenging, as we all know. But once you get them built and once you start educating both sides of the platform with the value proposition, you really start to see the flywheel moving.
Okay, so you've explained it, but just to make sure every listener here is completely capturing it. So on the one side of the marketplace is the homeowner. So I own a home in Austin, Texas. My genius twin boys finally get into Stanford, who's not giving it away to me for free. I need to cough up with a couple $100,000, and I can sell a home share and enter into this agreement. What happens on my side as the homeowner?
Yeah, you're exactly right. And the use case you just gave, Andrew, is actually one of the use cases. Paying for college, right?
Right.
Home improvement is another one. Or even just debt reduction, debt consolidation. People say, wow, like, why do I have all this debt hanging out there when I've got 50% equity in my home that's really trapped, right? And so that
maybe you were one of those 80% Twitter employees that lost their job.
Exactly.
Right.
So the catch is, or I hate to call it a catch, but right, we know money's not free, right? If you're doing a second mortgage, you're doing a HELOC, you're paying interest expense, you've got a monthly kind of cash flow impact from that. In ours, you don't pay monthly, but you're giving up a little bit extra share in the home. So just as an example, $1 million home and you want $100,000, you'd think you're giving up 10%. You're actually giving up 18% when you build in our what we'll call an exchange rate for the capital that we provide. So you're giving up a little bit more equity. But in exchange, you're getting this, and it's a 10-year term. So until you refinance your home, Andrew, or you sell your home, you don't have to pay that back until that.
Okay. So I can send my kids to college. My mortgage is not changing. My payment isn't changing at all. Correct. I'm able to deal with whatever life event I decided, whether it's home improvement, whatever. And whatever comes first, 10 years go by, or if I decide to move back to Silicon Valley and leave Austin, then I'd have to pay it back. That's the moving economics, right?
Yeah, you better not be leaving us, Andrew, because I did the move from the West Coast to Austin as well. So yes.
I think it's only a one-way thing. I think it's one thing to leave; it's another thing to move back into that house you were in before. Although there's a new mayor in San Francisco, so I'm excited to see them reopen. I don't know, maybe a CVS in town on Market Street again. Maybe not in my lifetime, but maybe that'd be nice. Okay, so on and how do the economics work on the investor side? Like before getting into like kind of the derivative with the city funds or all the different funds combined. So someone is receiving $100,000. What's happening on the investor side coming in on this?
Yeah, the investor side coming in is they're actually getting, number one, built-in downside protection, right? Because one of your questions, you're going to say, Tore, real estate, it's got markets, right? It's got movements, it goes ups and down. Because we've marked up that equity, we've actually built in a buffer on the downside protection, and actually we've built in a natural upside without even an event, if you will. So the investors that invest in the funds, it's really a growth-oriented fund, Andrew, so they should think of it as capital appreciation first and income second. So that, again, the income comes as we build enough volume in these homes. You can imagine the turnover from a refinance and a sell. There'll be distributions back to investors. There's not a declared dividend. And then we're also, this is exciting news, we're opening our secondary market in Q1. And so you can imagine having a secondary market allows investors to trade their shares. So they might buy in at, let's call it a $10.50 is the current NAV of the fund. But obviously as that fund increases in size and shape and valuation, they might be able to sell that down the road for $11 as the NAV increases. So I think that hopefully helps explain, investors should have a longer term kind of capital appreciation should be their goal. But there are options if they do want to have more income coming out of their share purchase.
Yeah, yeah. I mean, having spent decades raising LP capital for my own VC funds, I always think Houston, they're like, I understand. I just don't see the word redeem. Where can I redeem? And I'm like, sir, there is no real redeem in this venture capital fund. So if you can securitize, tokenize even your VC fund, I can see how that increases the set of people that are willing to get into it. So giving them a path to a secondary market of liquidity completely makes sense. It's the way I think, and securitization and stuff.
Correct. And what allows us to do that, unlike VC, as we all know, right? With VC, you are coming up with an unrealized, gain on the investments on a periodic basis. But here in Nada's case, the residential real estate, there's already tried and true outsourced market valuation services that we use. So every quarter we can mark to market. And so it actually is a more kind of scientific, if you will, way to come up with a valuation for the fund and ultimately for the shares.
Okay, so quarterly marks and with just maybe clarify the downside protection on the way in. Do you give was it like a 40% discount? So if it's $100,000, home share ownership being purchased, that if the quarterly mark says that's worth $100,000, aren't you're taking some sort of discount on the way in to protect against the volatility of real estate's going down as well as up?
Yeah, and we used to do the discount. You're exactly right. So there's two methods. The discount method, which is where we would discount the overall value by 15% to build that right in initially. We've now moved to, there's a new industry way to do it, which is an exchange rate. So on that $100,000, the exchange rate, it turns into being about $180,000 worth of shares that we own in the house. So it's the same way to come at, building in to your point, building in downside protection from day one on the investment that's been made.
Okay, so it sounds like because you've got these funds, it's almost like an M&A exchange rate of an all-stock agreement as a way of, technically, legally doing it. That makes sense. So if you're long on places like, I don't know, Tampa, Miami, Austin, Nashville, Dallas, you can not just, it becomes like a mortgage-backed security on the good side of MBS, that instead of just lending money to one old lady for her mortgage, she could default. If you can get 1,000 mortgages in that same, type of home and location, then you start building into a super risk-free, marketable security in a sense. With CityFunds, maybe explain how they work. So how many home shares are you getting when you invest in the oldest? What was the first Nada City to launch?
Oh gosh, and this is predating me. I think it was Dallas because
I think it was Dallas too. That's what because John and Maurizio were there. So if you get into one of these city funds, how many home shares are being built in now at this early stage, and what do you think that's going to look like in a couple of years from now?
Yeah, so we're just cresting nationwide over 200 of them. So if you get into one of those earlier vintage funds like Dallas or Austin, for example, you probably got about 25 different home shares in there. So to your point on diversification, and we're not just centered in an urban core, but we're kind of the whole MSA. So here in Austin, we'll have some investments in Leander as an example, right? So we kind of cross north, south, east, west across the city. So it has diversification by neighborhood, by size of home. We'll have homes that are 500,000 and other homes that are over $1 million. So I think that's nice. And then ultimately, and we probably are going there, Andrew, we built another fund called Select that actually allows an investor to have diversification across all of the different cities. So if they like that portfolio.
So you offer, you guys are becoming like a Vanguard Fidelity. So you offer city funds. So I can be like, hey, I'm going to give my goddaughter $100 worth of Austin. And by the way, I meant to wear my T-shirt. I forgot to wear it. These guys have T-shirts that say like "I own Austin," which is pretty dope. And then you just pick whatever city it says "I own Austin." It's so much. But so I could give $100 of Austin to my goddaughter on the day she's born, if I give her $100 fiat USD cash when she turns 18, that may barely cover a bagel and a coffee downtown Austin. Whereas if I give her $100 of Austin, owner occupied homes, that might actually go up by the time she turns 18. That's part of the thinking there.
Yeah, exactly. And you hit a nice term, owner occupied. When you think about that, Andrew,
explain that.
Yeah, it's really, I mean, this is novel. It's the first time ever that investors have been able to participate in investment into owner-occupied homes, right? The only way they've been able to do it before is they buy the home themselves. So that's a big cash outlay and debt, right? As an active investor. Here, you're a passive investor. You're sitting back, to your point, saying, let my money work for me. Let me pick which city or pick, all of them by going in the select fund and see how this capital works. And again, owner occupied versus, we do rental income properties as well, but that's about 20% or less of what we do. It really puts the investor and the homeowner on the same side. The homeowner, right, wants to see their home appreciate. They would like to have a nice gain on their home over a period of time. And so here we're well aligned with the interests of the homeowner and the investor at the same time. It's not it's not like a bank versus the homeowner.
Listen, I live in Austin, like you. If you gave my wife $20,000 to spend at Lowe's and the Home Depot on flowers every month, she would spend it. She would get there. So the owner occupied thing, it's like the opposite of the original migratory, almost ghettos of New York City with immigrants coming in Ellis Island. They lived there until they could afford to move out. And then it just got worse and worse and worse without owners occupying. So you do think these people are going to Lowe's and the Home Depot every weekend, making their home a little nicer while you're passively owning a derivative of them. Okay, so there's different cities. And then it's just click to select all, and you could be diversified across all the cities that you guys operate?
Correct, yeah. Our select fund gives them access, like to your point, an index type of fund. Not only is it index across the cities, but it also does off-market deals. So for example, Charlotte.
What does that mean?
Great market, Charlotte. We don't have a city fund in Charlotte yet, right? We haven't built up enough volume, but we'll have deals come to us in certain cities that don't go into a city fund, but will go into the select. So it's a little bit juicier fund, right? You're getting that diversification across city, but you're also getting some what I'll call off-market deals, right? People always love off-market deals.
Okay.
Yep.
Well, and that's interesting. So from the exchange perspective, you're able to move on more things that are coming in the net rather than, sorry, we haven't done Charlotte, North Carolina. Looks like we're going to do Raleigh-Durham first. What are the funds that you guys are active in, and what has been the calculus of why those cities and not, say, I don't know, San Francisco, Palo Alto?
Yeah, I mean, it's actually an interesting investment thesis similar to what we had at CrowdStreet is kind of, these 18-hour cities, where the Nashvilles or the Phoenixes or the Dallases, the Miamis, right? Job growth, we look at job growth, right? We look at demographics. We look at, home ownership percentage as a total, right? I mean, we know in some of those other cities, it's almost unaffordable. You get people that have to rent that have huge incomes.
That's right.
Because they're priced out of the market. So we look for strong home ownership. So there's a lot of criteria before we go into a city that goes into the decision about, why did we pick a Tampa? And we just actually are doing Philadelphia. It's a pre-IPO city right now. We looked at other cities in the Northeast. We landed on Philadelphia and the surrounding parts of Philadelphia. Again, not just in the core, but outside as well as what's happening in the suburbs there. And so we just announced Philadelphia recently as a kind of a pre-IPO fund.
What do you mean pre-IPO?
Yeah, so we're making it exclusively available just to the accredited investors on our platform before it goes public, before we make the shares available to the general audience. And what that allows investors to do is get in at an entry point of $10. It's kind of like a pre-IPO, right? We all know before it goes public, if you got in on a share discount, you made some nice bump right on the opening, right, or over the first few months. So we're allowing investors to get in before it goes to the general public audience.
That's pretty smart. I mean, if you think about finite inventory and how many investors have access to it, and then you flick a switch and you're able to communicate it to all of your, I suppose, retail non-accredited investors, there's going to be some response from that. And so that'll increase demand for the finite supply, and it should, within your little controlled economy, move the price up.
Yep.
And reward those. And what have you seen? You've got like nearly 11 years experience at CrowdStreet with this, but what are you seeing on the range of ticket size or check size from a first-time participant on the non-accredited retail side on purchasing, a slice of a CityFund or the select, full index, from low to high? And what are you seeing on the range of ticket size on the more accredited high net worth individual that decided I'm enjoying? I've talked to a lot of people about investing in Nada itself, and then they end up getting into the city shares.
Yeah, exactly. And so one thing that we just did recently, Andrew, and this is probably, again, my influence is coming in, looking at the data, looking at the numbers a little bit, because having a $500 minimum, we all know, you have to have a really good unit economics when you're out marketing to bring investors to a platform. And at a $500 minimum, it's really challenging unless you have a big distribution partner that's going to bring those millions of non-accredited investors. It really makes it challenging. But to your point, our average from a non-accredited investor is right around $2,000. All said and done, they're kind of total wallet size. The accredited is right around $15,000. So recently we are actually testing out a higher minimum on the platform at $2,500. And when you think about it, right, what's our audience is really accredited investors, and then this other big group called mass affluent, right? People always talk about the mass affluent audience, and that's kind of that, underneath accredited, but they're making $100,000 a year. They'd like to put money into some alternatives outside of their kind of stock and bond portfolio. They like the click to invest capability, but maybe they only want to put $5,000 or $10,000 in. Having that ability, because we do the Reg A kind of SEC format, it allows us to kind of spread from accredited to the mass affluent. But we kind of notched that investment average. I know you mentioned $100. We might offer that from time to time, but we're really kind of testing out the higher minimum, which is going to give us a higher average overall.
When you look at what's my cost of acquiring a customer, what's my, how much money, how soon do I get a payback if it's below a certain amount? How many months before they maybe re-up again with their next paycheck comes in, they buy some more CityFunds? If you raise the minimum, you theoretically could spend more to acquire that user when you're, scaling on the internet. Yep. Rather than meeting each one of these people one-on-one. Another thing is, we have most of our portfolio companies, even today, we're excited to be investing in Dallas, Austin company like Nada, but Silicon Valley Bay Area is still number one for us, and New York City, surrounding area is still number two. And, I kind of lived through the lives of many of our co-founders and even their employees and watch what happens. It could be frustrating for you to live in London, New York, or Silicon Valley and watch property prices go up 15 or 20%, 25% year on year during these bull years. And you can't afford the $500K down payment to put you in a little 2,000 square foot house. I jokingly say the reason why Apple and Hewlett Packard were all founded in the garage is because that's the biggest room in the house over there. You literally couldn't build a computer in that tiny, basement living room of yours. But to not be able to participate with home ownership when you're living there, Nada almost gives you an option to capture, this accretion that you're aware of that's all around you, but you just couldn't get through mortgages and all that and down payments. It's interesting.
Yeah. And it also gives, again, when you think about what have people traditionally, when they've invested in single family residential, right? They've done it in their local market. What we're allowing people to do is basically diversify outside of their local market, right? Because they usually will buy the rental income property that's somewhere in their proximity because they need to get to that property. Here,
right?
They might say, I'm in San Francisco, but I really would like to get into Austin real estate. Well, we're
Sure.
given a chance to do that, and it's really easy to do it. So I think that's
Yeah.
we saw that at CrowdStreet in the commercial projects. We had a very small percentage of people that were actually investing locally. They were investing outside of their local market because many of them were already long in their local market. They'd invested with a local developer in a multifamily project. And they said, I need storage or something else outside the market. The same phenomenon plays here at Nada.
Yeah, yeah. It is interesting that you typically own some apartments that you could drive to and show up and deal with emergencies and issues, whereas the owner occupied thing, you just expect that they're going to Lowe's and the Home Depot themselves, trying to get the most out of it when they can. That is interesting. So when I've looked at my own experience going back to the 90s on exchanges or two-sided marketplaces, I remember I founded a company called the Global Tele Exchange where we were putting fiber optic cable, bandwidth, even dark fiber onto an exchange. And what we experienced, I've now seen as the VC, when you have a two-sided marketplace, everybody wants more money and they want to sell and increase sales. So NTT, AT&T, WorldCom, they all put all their capacity on our little website. I was like 26 years old and I'm like, holy hot damn, we're going to be billionaires backing out the UN as philanthropists because we've now got almost trillions of dollars of capacity to be purchased on our exchange and take our little slice. Getting people to show up to the Global Tele Exchange was a lot of work, but you could do it. So it was a lot of work to get all the inventory on. And this is telecom, nothing to do with real estate. Then we did have co-location data center because you need to drop your electronics on both sides after you buy that fiber. We got people to come and browse, but let me tell you what happened. They often said, look, I'm going to take the price I got from Andrew's GTX, Global Tele Exchange, and I'm just going to show it to WorldCom and say, look, I don't know who these Brits are. They can't service their debt. I want to go with WorldCom. And so we were getting disintermediated, and that was kind of happening. What have you found as someone who's been very successful in these two-sided online U.S. real estate marketplaces? What are the dynamics of this?
Yeah, no, that's a great question, Andrew. Boy, we only have an hour today because I could go for a long time on this one.
I'll bet.
If I had to boil it down, one, you just nailed it. You got to control the leakage, right? We always talk about leakage on marketplace. Even Amazon will have some leakage, right? No, I can go direct to this, website. Although, most people are just like, I'll just get it through Amazon now. And so, how do you control leakage as a marketplace to make sure they don't come and browse and then do it offline, or God forbid they do their first investment through you and then they go direct, right? And so I think the beauty of Nada, we control the leakage because we're the ones that are actually doing the origination side of the business as well. So we've built that leakage kind of, again, minimizing leakage because people wouldn't say, oh, I'm going to go invest directly in just one of those homes because we've done it as a portfolio of homes. And we have the whole origination business that's doing that. I'd say the second big thing to get that marketplace and, is really making sure from an education perspective. And here, I told John the other day, I said, John, think about the weight that's on our shoulders as Nada, as CityFunds. We are the ones out there trying to educate investors about the value of this HEA, new investment asset type. And so I think, if you come to CityFunds, you'll actually see we've reoriented the website from invest in a city to invest in HEAs. And by the way, here's how you can do it. So I think doing a better job of really, and again, you got to do this again in the digital paradigm, you have to do it really quickly, right? How do I get their attention, whether it was on the ad where you're starting to warm them up about you pique their interest to then they get on the site and how do you get them kind of right away? So even building in things like the webinar that we do for new investors, right? Getting them engaged quickly and understanding, because it is fairly complex. And then obviously helping them as they make their first investment. You have to create an awesome online experience, right? Because you can't do this at scale in an offline way. And so I'd say those are some of the key aspects to success that if we do those right, and then obviously it's a financial instrument. You have to be showing returns to investors. Ultimately, it's about the ROI. There's an impact aspect to this. Investors could feel good about, hey, I'm helping homeowners maybe stay in their home because now they can actually tap their equity, but ultimately it's dollars and cents. And so the funds, since inception are running kind of mid-teens IRR on an unrealized gain so far. So showing investors that their investment is appreciating, launching our secondary market, giving them even that option to, if they need to sell some of their shares, creating that loyalty over time.
So if somebody were to invest, say, $100,000, and I realize that's a bigger ticket, but it's math no one needs a calculator to follow, what's the expectation of where that 100 grand is going to be in some of these high performing markets in a 5 to 10 year time horizon?
Yeah, and I usually like to use a 5-year horizon because when you think about it, the average homeowner turns over every 5.2 years or something like that.
Okay, that's the actual number.
Yeah, it's something around there, 5 and change, right, is the average kind of turnover. And I think what's going to happen, we're actually going to see that increase over the next couple of years as mortgage interest rates drop and homeowners, we see a little bit more activity in the market and people saying, oh, now I'll sell my home. So, we'll probably see a higher turnover. But I think, 5 years is a good horizon for people to think about, in terms of their gain. And so I think mid to 18%, 15 to 18% IRR is kind of the place that I would say they should think about this. Maybe not as high as sometimes the VC investing, but a little less risky, right? I think to your comment earlier, if you look at the pendulum of alternatives, venture capital is definitely on one end of that pendulum. I mean, again, great growth oriented investments, but it's probably a little closer to the middle of the pendulum on the real estate. Maybe not. Yeah. You're not going to have the grand slam, but you're going to have a nice return over time. You know that you're investing in certain, thriving, growing markets.
Yeah. I mean, as one entrepreneur to another, educating people on viewing venture capital as a zero risk or low risk asset class is a burden. Whereas I think education on your end is ultra important in how you do that online. But most people already think some of my pizza pie portfolio should be in real estate. What about working through wealth managers, like registered and independent advisors, RIAs? I would think that you get some of them on board, and that might help scale. That's even something we can help you with, perhaps.
Yeah, no, Andrew, and I think if some of the viewership or readership is listening, like that are in the financial advisor, we love those conversations. I found at CrowdStreet, we would have some very active advisors that would reach out to us and say, hey, I'm used to working with my high net worth investors and putting them into individual real estate deals, right? But they usually are local deals with local developers that they have.
With no liquidity like the exchange that you're offering.
Exactly. And so, again, like a startup, right? We need to start working with these advisors. We're not going to get Morgan Stanley or JP Morgan to jump on board right now.
Because they get a kickback for the on-platform thing they offer. I mean, it's one of these things that it's amazing that's not illegal, but it is. So you probably want to avoid all the wirehouse, big bulge bracket guys.
Exactly. Until we're the size of Blackstone, we're probably not going on us as platforms. But the independent RIAs are really, again, the ones that are active managers that really look at that. And I think, it comes down to some early adopters. It is a challenge for them, right? They're a fiduciary. They have a fiduciary responsibility to their clients. But again, residential real estate is something their clients they're already in, because they're already in their own home. It's an easy conversation for them to have of like, wouldn't you like, you're an owner occupied yourself, wouldn't you like this investment? So we're in those early conversations with some independent RIAs who are willing to take a little bit more risk, right? It's not it's a new asset type, and so I think it's a huge channel opportunity for the company. But it does take us, direct is you have to kind of go direct first before you can open that channel. And it kind of
true. I think with all even when I was in enterprise SaaS and telecom deals, you could sign a bunch of distribution agreements, which mean nothing until you start winning British Telecom and a few good customers, and then they see money and they go after it. So offline as a follow-up, that's something that we should be talking about immediately because we can help you with that. In our experience of working through these guys, it could be a bit of a slow relationship development thing. So, we've come to be calm. I'm saying, all right, looks like this is not going to happen for Fund 4, but there will be a Fund 5. So let's talk now about the next fund, even though this thing is still open. And, hopefully they get there. I would think the RIAs and their clients are far more pre-educated that real estate is an asset class I can be in. And if you describe it as this like index fund of Miami, Tampa, Orlando, Nashville, all these different places, Austin, Texas, they might realize there's a huge exodus of guys like us leaving Silicon Valley and coming here. Maybe they should own a little bit of it.
Yeah, and you can kind of think of it like a REIT, right? I mean, it's structured almost like a REIT would be structured, right? Diversification across kind of different places and things like that. So I think they're accustomed to REITs, public and non-public REITs.
Yeah, I mean, I remember some of my earliest days of investing in these like Southeast Asia fund, Latin America fund, that like Vanguard or whatever, messing around with my 401k. So I think to productize it, there's an emotional side that's getting people on an emotional hook. Like, I love Austin, I love Nashville, whatever. And then there's kind of the rational side of I can get you into the city that you don't live in, and then the basic rationale of a mortgage-backed security is worth more when you bundle more, or at least it lowers the risk,
Yep.
So for moving forward in the next 6, 12, 18, 24 months, what do you see as the key steps Nada has to go through now that you're the CEO and running this thing? What needs to happen to have a smashing, skyrocketing breakthrough?
Yeah, I think a big one is, and again, we talked about it earlier, Andrew, which is that other side, that investor side of the marketplace, right? Getting the education out there, getting the adoption, getting the conversion rate. So again, I've been in the online, marketing space for many years. The beauty is you can measure it, right? And so, we are a very metrics data-driven company, looking at not only how do we bring them into the site, how quickly do they register, how quickly do they engage, and how quickly do they make their first investment, so you can increase those conversion rates, so you can get that marketing dollar spread. So this is key, right? Because if we
what about that follow-on investment? You guys are evolving with lots of data on the re-upping, which I was excited to see.
Correct. Yeah.
So I mean, that's something that you want to get right.
Exactly. You get that right, and then as you're pouring in more capital, right? It's just, hey, you're building it and you're actually increasing conversion rates at that point. And so you're saying, okay, I'm actually getting more loyal investors. I'm putting more things on the shelf for them to invest in, right? Because again, you want them coming back more and more to reinvest their capital. So I think that is job number one. Job number two, which we just solved, is we when you think of CityFunds, it's all equity, and this, Andrew. We all know this. It's good to have some leverage in those funds, right? It actually have a levered return, and so we announced 2 months ago a relationship with Kawa Credit Capital Management out of Florida, a big kind of asset manager. And they extended a $25 million credit facility to Nada, to CityFunds specifically. So we're now bringing some leverage into those funds, which grows that pie. It's kind of I don't want to say it's a cheating way to do it, but it's actually a very responsible way to do it by bringing some leverage. It helps actually the investors in the fund to have some leverage.
Yeah.
And then it gives us more capital to go do more originations, which ultimately serves the investors better too, because you've now got a bigger pool of assets.
Yeah. I mean, I would think that if you had invested in any one of these city funds, you want to know this leverage is functioning and working. There's a debt equity, ideal structure for any real estate play that's equity related when you think about it. Okay, well, that's great. And maybe on wrapping up, you've been in fintech, property tech, real estate world. What advice would you give to other entrepreneurs building a real estate tech or property tech, fintech, opco, holdco kind of structure? And we don't have 10 hours. I'm making this hard for you.
I'd say a couple things. One, and again, I learned this lesson. We learn our lessons, right? I learned the lesson at my early days in CrowdStreet with Darren, my co-founder, which is, you think it's going to happen fast. It's always going to take twice as long, right? I mean, we've all heard this, right? and know both sides of that marketplace, know the pain points, and solve them quick and early. And so at CrowdStreet, just as an example, I thought, I'm a tech person. My co-founder was a real estate person. I came in and said, this is amazing. We can build an online platform. Investors now can invest as low as $25,000 into a commercial real estate. What I didn't spend as much time is learning what the commercial real estate developer's mindset was. Talk about 20 years ago, technology adoption. Wow. So we had to spend a lot of time building that supply side before we could get the investors on the platform. So my advice to the entrepreneurs is really make sure you understand those pain points on both sides of the platform. And we had to pivot pretty hard at CrowdStreet to create a SaaS platform to technology enable the real estate developers before they would even use our marketplace. We created an e-commerce platform to merchants back in the late 90s. So I think that is a really important learning, because people always think, oh, of course both sides are going to use it. And of course I've done some of my primary research on this.
Yeah, I mean, my limited experience, and even watching other exchanges that seek funding from us over decades of, are they selling sneakers? Are they selling video game, virtual goods, whatever? It seems easier to get the inventory for sale. So in this case, people that want to sell a home share and they want cash to send that kid to college or put their mom in a hospital, whatever. And it's harder work to find the people to be putting the money in and be making the purchase. That's been my kind of Shakespearean timeless view of every exchange I've basically ever witnessed, from my telecom one to being the outside investor guy.
You're right. And this was a key reason why I joined Nada's board last year, and then joined John in June to say, sure, I'll come in as CEO. I was so excited that supply of homes was infinite. Right, that
yes.
Is not. Whereas at CrowdStreet, trying to convince a real estate developers raise capital from institutions and family offices to say, hey, put your deal on this online platform. What a heavy lift! And so
honestly,
this is
the fact that you've done. Yeah, the fact that you've gotten 4.4 billion, and that's amazing, because a lot of these people that are those real estate developers are the LPs in our fund, especially like in the San Francisco Bay Area. And these guys, when they raise money, they're raising big. I mean, they have these relationships of, it's all family, people that trust them, and they're raising so much money. I can imagine if you said, hey, meet my friend Tore, he's going to get you onto CrowdStreet. They're going to be like, I'm just going to make one trip to London and I'm going to come back with so much money. I'm not going to bother with figuring out the internet and all these screens I got to go through. I'm just going to keep going back to the same old lady that I've been building buildings for in the past. Whereas if you say to the American public, good times or bad, you might want to sell $250K and make an angel investment. There's no limit to the reason a family could use some cash and not want to sell that home. Exactly. That's interesting.
Exactly. It's very easy on that side of the platform. Yes.
Okay, Tore, is there anything else maybe we didn't cover that you'd like to share that's important to understand of this kind of new asset class that you, John, and Maurizio have been making?
No, I think, gosh, we covered a lot in a little bit of time, Andrew. So it was,
okay.
I think, again, I love, innovating a new asset type, a new asset class. I think if we fast forward 5 years, this is going to be a common thing. Right now, this is a small amount when you think of $30 trillion market, right, for real estate in the U.S. And that's the amount of capital that's locked up in homes. I think homeowners, now that when they see this, they're giddy almost. And then I think,
I remember, who is it? Like I think you guys even didn't you guys have a deal with someone trying to sell solar panels? Yes. That they're trying to sell solar panels in Costco's or something. They're like, hey, you're short 25, 50 grand. Sign this, and you can go green and heat your pool all winter.
Yeah,
let's
exactly.
go.
We have a partnership with a major solar company that is exactly what they're doing. They're saying, hey, if you need to finance this and you don't want to impact your cash flow, you can tap into the equity you already have in your home, and you're now actually increasing the value of your home. So so
you guys. We got to figure out how to make the ultimate business development team at Nada that figures out how to finance the sale of whatever the hell someone else is trying to sell, and then just increase the feed of these home shares. Because it seems like that's the limitless pit, the multi-trillion-dollar American, homeowner thing. And I guess before this conversation with you right here today, it didn't fully sink into me how impact all of this is. Like every politician, regardless of what side of the aisle you're on, everybody from the government and the media should be supportive of this. The more successful Nada is, the better it is for these people to be able to access some cash when they need it. And God forbid, not be forced to sell their home right before their kid graduates from college. I mean, that's a real impact thing.
Yeah, I mean, you're exactly right. There's another impact. I can't announce it yet, but we have a major partner that we're working with. It's kind of coming out of its pilot phase, but it's a major player that works with clients around debt reduction, right? And helping them. And sometimes their products aren't a perfect fit, but then they have the conversation with the client and they learn how much equity they still have in their home. And they're like, well, this Nada solution can help you stay in your home and pay off some of those debts, right? And so I think, again, it's another impact type of thing. And again, I think we've had accolades back from the homeowners actually who it's had a real impact on their lives, and let them stay in their home, let them be a little more financially secure, if you will, and ultimately they also increase their FICO score by doing so. So
there you go.
Yeah.
There you go. That might be pretty key for what they get for the kids' student loans or whatever they need. So Listen, make sure we've got in the show notes the correct links for people that want to learn about investing in the city funds. This is open to retail, accredited, non-accredited institutional investors, making an impactful, low-risk, high-return investment. And share any information. Anybody wants to get in touch with you, they can always get a hold of me. And we'll get that in the show notes. So thank you so much, Tore, and super excited to see where we are a year from now.
Yeah, thank you for having me today, Andrew. Really enjoyed the conversation.
Okay, great. Bye for now.